Good morning. My name is Atisha Naidu, and I'm from the Global Markets Retail Investment Team. I'm once again joined by Tom Gale, Executive Global Markets Trading, Standard Bank. This is the Market Pulse. Good morning, Tom.
Good morning, Adi.
We took a break last week. There was a lot going on. There's quite a bit going on at the moment. Hopefully, you can bring some calm to the storm and give our listeners some insights for the week. What do you have for us?
Did we pause last week? Because I'm losing track, I must say. I mean, as you rightly say, everything is pretty mad. I did actually earlier today have to just check my calendar that it really is the end of October, and we're almost at the end of 2025. So it has been one of those years. Markets, as you say, there's been plenty happening in the last week or two to get our head around. And look, I forgive and excuse everyone here because we have also struggled here and there to get our heads around what's going on. I thought that
Forgiven.
thank you. I thought that I'd start by trying to summarize our thoughts on the trading floor here. So I've got some bullets. Actually, before I do that, I am reminded every now and again by wise heads, some experienced folk, often more experienced than me, that markets in our era have really just been driven by liquidity. And what I mean by that is there's so much liquidity in the financial system. There's cash or cash equivalents, there's liquid investments, that the tendency always is to buy dips. We saw that on steroids back in April. I read this morning that US holders of mutual funds, those collective investment schemes in the US, are long $1.7 trillion worth of mutual funds, more than the long-term average. So they're very invested in the stock market. But also that reflects how much markets have rallied and how good markets have been to folk. So folk will buy dips, liquidity will be there on dips, and so on. We're probably going to see some of that sort of mentality play out again in the next few weeks. We had some wobbles in global markets, and I won't go into detail right now, but some of this relates to some credit defaults in the US. By the way, you and I were talking, I don't know if you remember, Adi, earlier in the year, around delinquencies in the United States. Delinquency is late payments, bad payments for credit in the States. We've seen that come to a head in the subprime auto market in the last month or so, the collapse of First Brands and Tricolor, and delinquencies now rising at quite a pace amongst the commercial real estate in the US. So certainly there is some strain under the bonnet, and we always have to sort of separate what AI is doing and then what the economy looks like without AI, because they're very different pictures. But anyway, I'm sort of drifting off on a tangent here. I want to get us back to what we expect here in global markets at Standard Bank. We think things could remain fairly choppy and volatile for the next week or so.
But I mean, choppy and volatile. I'm looking at the markets at the moment. We've been in a all-time high. Are we saying there's a sell-off coming?
Well, Adi, blink and you missed it, but we had a bit of a sell-off. The S&P lost 3%, and then the dip got bought. But I do mean, yes, some choppiness and volatility in US markets in particular. If it happens to the US and they sneeze, we all catch a bit of a cold. So everywhere to some extent, yes. Yeah, it's not like we got used to for a little while, where you log in every morning onto your OST platform and you see markets are higher again. We'll be choppy and volatile for a little bit, but we think then okay. And in fact, we're anchored in that view by the prospect of a US-China trade deal by November the 10th, which is when the moratorium, Trump's moratorium on those tariffs expires, lapses. So the tariffs would, in theory, be reapplied. And by the way, this is not us taking a guess. We're looking at Polymarket in the States that shows an 80% chance that the deal will get done. And Trump himself was tweeting on Truth Social last night that everything will be fine with China. So we're also buoyed by the sense that AI is driving growth. Adi, I don't know if you want to plug our AI auto call.
That kind of talks back to the AI auto call we mentioned in the past two pulses, and along that line of the fact that there's so much evolved and surrounding AI right now that kind of structure looks great, and the fact that you've got it right there, those two superpowers are central to it. So you mentioned though that what does it look like with AI and without AI? So maybe you should elaborate.
Yeah, I'm not going to go into any detail here because we have talked about this before. We know that most of the US growth this year, and the US might end up doing about 2.8% GDP growth this year, but more than half of that, as we've discussed here, has come from AI capex.
Yeah.
And it's the big tech in the US that's spending hundreds of billions of dollars to build out AI capabilities. But also, as you say, in Asia, China is also in a race to develop its own AI. And in fact, this morning at a plenum, political plenum in China, in Beijing, the Politburo also pledged to focus on AI growth. So that's why, actually, as you say, the AI autocall product that will be launching soon, it is launched or will be launching, Adi? Is it ready?
It is launched. It is live. It's closing on the 3rd, remember. So
closing on the 3rd of what?
3rd of December. So
okay.
It is live at the moment. It is on online share trading. The brochure is there. The last two pulses, I think we covered it a bit. There's webinars coming out shortly as well for the base. So there's a lot going around about it, and there's a lot more education surrounding it. But yeah, I'd say, given what's happening in markets, there's a lot that can be benefited from a client actually looking at this product. I don't want to go too much into it.
Okay. So then, we think that another week or so of a little bit of choppiness, and then the risk rally resumes, buoyed by AI growth and buoyed by liquidity, plentiful liquidity, and the risk rally may broaden into some of the sectors that have not done so well this year in the States and globally. Precious metals, gold and platinum, well, they've done a lot. So we feel here in global markets
at 4.2, I think that's an understatement.
You're referring to $4,200 for gold.
Yeah, I think that's an understatement. It's done a lot.
It's done a lot. And we're not saying that it's going to fall. In fact, we remain very constructive. Our analyst, Adrian Hammond, has a target of $6,000 per ounce by 2027. It's just that we've done a lot now, and possibly a breather is what's warranted here. There's now starting to be a bit of investor frothiness creep into the gold. So ETFs now account for something like a fifth of demand for gold. That's quite high. So we remain very constructive on precious metals, platinum and gold, but just for the short term, just for the time being, they will take a breather, and there may be more upside actually in some of the base and industrial metals, copper and aluminium, for example. A reminder to your audience that they can trade precious metals on the JSE through our ETFs. We've got gold ETF GLD, we've got platinum ETF PLT, we've also got palladium and rhodium. And if they want to look beyond the precious metals, we have JSE listed ETNs, Brent crude, SB oil, and copper, SB COP.
I was just about to touch on them, but I think you've given those share codes as well. So yeah, those are the codes for online share trading.
Okay, that's right. Now, you and I spoke about this slide that you're looking at right now, we spoke about it in the last pulse, and we were saying, well, we remain bullish on gold in the long term, but just be careful with the miners, the South African listed miners, because their valuations are a bit stretched. And it's often the case that the miners will race ahead of what the metal is doing, or at least they will price a higher metal. And we did talk at the time about Gold Fields looking the most rich, because it has been pricing gold at 4,700 when gold has been trading below 4,500. So we just delivered a note of caution about our gold miners being very fully priced. There's no value in them. You own them only if you think gold is just going to keep going. And we said, our head of research, SBG research, and head of our resources sector, Tim Clark, we talked about this, Adi, that he prefers South 32, Glencore, Exaro, Kumba, and Merafe. There's value in those. They're not reflecting the right metals prices. So if you're looking for relative value and you're happy to stay away from the exciting stuff for now, the golds and the platinums, then these are worth a look. But I just want to mention that risk wobble we were talking about a moment ago, and add another piece of context, which is although credit spreads on the left widened and on the right the S&P dropped 3% before it steadied again, I think a lot of market participants are comforted by what we call the Fed put, and that is just this sense that the Fed is going to bail out investors in a sense. Well, that's a bit loose when I put it like that, but the point is that the Fed is going to cut rates, and the piece I've circled in red here is showing you that the market is absolutely convinced with certainty that the Fed next week at its meeting will cut by 25 basis points, and they will cut another 25 before the end of the year. So a total of 50 basis points at least. So probability of more than 100% of 25 basis points cuts.
Tom, I just want to stop you there. We've said in previous pulses, you've mentioned, when we see a cut, we see a rise in gold. But you just mentioned now that gold is going to ease. Any thoughts?
Yes, it's a good question, Adi. And I'm going to give you full points for having listened recently. I want to in attempting to answer that question, I'm sharing a slide now that shows South African terms of trade. We've talked about this many times. Terms of trade is what we export minus what we import, and of course that's done very well, really, because of gold and platinum. So terms of trade on the left has been at a record high, very favourable for the performance of the rand. The chart on the right, and number of your audience will be quick to this, will notice the white line on the chart on the right is the gold price. And I've taken the chart back because I won't reveal when I was born, but it was certainly towards the left-hand side of that chart. And so it's really been a recent thing that gold has just gone berserk. The line in blue, by the way, is platinum, but I just want to mention gold because you're asking about gold. And part of the reason that gold has done this, part of the reason, is declining US real rates. There's plenty more to it than that. There's also what we refer to as debasement, the losing allure of fiat currencies. It's also to do with plentiful liquidity that we talked about. There's also the hedge against the dollar and central bank reserves and so on. But just for a moment, you mentioned declining US rates. And yes, you are right that is supportive of gold. But just careful what I said a moment ago. I didn't say that gold is going to fall in a heap. I said that it's just going to trend sideways. It's done a lot. Look at that chart. It's done a lot. And so the US cutting rates will provide some support for the gold price here. We don't think that it's about to propel the gold price in the next few weeks. But into next year, Adi, as I said, Adrian Hammond, our gold analyst, has a target of $6,000 by 2027. But we've got the best part of 2 years to get there. So let's leave something on the table for now. By the way, if your audience is wondering why gold and platinum wobbled this morning, I just want to cover that briefly. China at the plenum did announce that VAT refunds on purchases of platinum and gold will be scrapped. That is to say, you paid it when you bought them in China, and then you went and got a refund. That is no longer going to be the case. You'll pay VAT. And so that's led to a bit of a wobble in metals prices this morning. By the way, last week in the US, the exchanges raised gold's margin. So if you're holding gold long on an OST equivalent platform, you had to post more margin. But Eddie, given that there's been so much going on, I didn't want to overwhelm you and the audience today. And frankly, as I say, there's a fair bit that professional and not so professional investors need to get their head around. And I'm just going to leave off on a couple of reminders. First of all, that the IPO, the AI IPO that's coming to the JSE, well, the books have opened today, Optasia.
Yep, it has. Clients have been notified on online share trade.
Yes, and you'll I'm sure you're going to pick up on some decent interest from your audience. We're certainly seeing a lot of interest from institutional investors. And then finally, a reminder, as we have been reminding on many pulses recently, that there's plenty of value still in the JSE. Yes, we are vulnerable if gold wobbles. Of course we are. And we're vulnerable if the S&P wobbles. Of course we are. But nevertheless, the JSE remains the place to invest for relative cheapness and still therefore for relatively good returns, even after a couple of years, what's shaping out to be a couple of years of world-beating returns. And that's the good news. And I want to leave you and your audience with that reminder. We've been banging the drum on this, as you will attest to, for a good 18 or 24 months. And the good news is we remain in a good place.